What is going on, everybody? Welcome back to Finance with Parks. In today's video, we are going to try to make tax brackets fun. That's right, we're going to talk all things taxes, 2021 brackets, how you can get prepped for 2022, what deductions are. We're going to get into it all. Let's talk about it. Welcome back to the channel. If you're new here, please consider subscribing. We talk all things personal finance, and we are trying to make it to 1,000 subscribers. So if you could help us out, liking, sharing the video, that would be greatly appreciated. All right, per usual, we're gonna get into sharing our screen here. Got some slides to talk about. So first thing here is just a screenshot from our good old friends at the IRS, right? The tax brackets for 2021. So I assume most of you understand, right? It's broken down into brackets depending on how much money you make, your taxable income. So we've got it in two main categories here. You've got single, a person filing alone, or married filing jointly, right? If you and your spouse are filing your taxes together. Obviously, those are going to have different brackets because you've got one person's income versus two. Pretty straightforward there. Now let's look at the percentages themselves, right? That's essentially going to tell you if you are single and make up to $9,950, that total, 9,950, is subject to a 10% tax rate, right? So now, if you jump all the way down to the opposite side of the spectrum, if you're making over $523,600, then you're in the 37% marginal tax bracket, right? Almost 40% of your income at that level is getting wrecked or taken by the government. So now, one of the most common misconceptions, kind of what I just talked through, right? If you make over 523K, all of your income is taxed at 37%. If anyone tells you that, we gotta cancel that person. I'm just kidding. Kind of. That is false. That is not how taxes work. It is based on the ranges that your salary falls. You're going to pay that tax amount until you get down to your highest tax bracket. So I know that probably doesn't make sense right now, but let's talk through it as an example, right? At the end of the day, if you make over let's say you make $524,000. This, I think, is the easiest way to explain it. If you're in this scenario right here, you make $524,000, only $400 is getting taxed at 37%. If you take anything away from this video, that would definitely be the most important thing, right? It does not apply to all of your income. It is the money that you make over $523,600 is taxed at 37%. Anything before that would be taxed at what? Anything you're making in between $209,000 to $523K is only getting hit with 35%. See, you're making out. The government's giving you a 2% deal. All right, so with that said, let's jump to an example because I think that will help as well. So we've got a single person making $200,000 a year of taxable income. Now, keep in mind, I do keep throwing out taxable income in here because there is a nuance that we'll talk about in the following slides. As far as this isn't just as simple as the total money you've made. We'll talk about that in a second. But for this example, we got $200,000 of taxable income. So how this is going to work, and we kind of talked through it, right, is this person is actually going to pay the same amount of tax on the first $9,950 that they make, the same percentage that somebody who only makes $10,000 a year would pay. So how that math works, right, is you take the 9,950 times 10% equals $995 worth of taxes. However, the person who only makes 10 grand a year gets to stop there, right? They only owe $995. This person's making $200,000 a year, so they have to continue going through the tax brackets until they get, maxed out at their salary range, right? Okay, so we have to go down to the next one because they make more than $9,950. So this range here is taxable at 12%. Well, you got to take the delta between this range, the 40,525, subtract out the 9,951. That's going to get you $30,575. That's eligible to be taxed at 12%. Hopefully everyone's tracking that. So you've got the 995 you paid in bracket 1. You've got the 30,000, which is the delta in this range. You multiply that by 12%. You add those two together. Now you've almost paid $5,000 in taxes after bracket 2. All right, let's jump down to bracket 3, right? They're making more than $40,000, so you have to keep going. Okay, so now in this range, you take the 86 minus the 40, and you get an even larger bracket, $38,024. You've obviously got to take into account the money you paid in bracket 1 and bracket 2. Now this total gets multiplied by 22%. So the percentage is going up in a hurry, right? Do you notice that? They're nice to people at 10K, 40K, still at 12%. All of a sudden, you're making 86 grand anywhere in here. This 40 to 86,000, that's getting wrecked at 22%. All right, so with the math here, you can follow along. $13,029 worth of taxes. Now, just to not bore you to death, we won't continue to the example. If you're a math nerd, you can keep going, and you can go all the way down, right? And so where you would stop is you would, in this bracket right here, because they don't make $209,000, the math in this bracket would be 200,000 minus 164, so somewhere around 36 grand, right, of taxable income in this bracket, times the 32% would give you that final tax liability in that final bracket, which I think would be bracket 4. Bracket 5 is where you would stop the math there. All right, so hopefully that was helpful. Now, let's talk. So we've talked through the tax brackets, right? Let's talk about two terms that are very common when it comes to taxes. That's effective versus marginal tax rates. Now, this is right in line with what we've been saying. Marginal tax rates are the highest tax bracket you are a part of. So in our scenario with the 200K, right, their marginal tax rate is 32%. Now, keep in mind, that's not the actual percentage they're going to pay in total. Why? Because partial of their income was charged at 24%. Partial was charged at 22, 12, etc., right? So that's the highest tax bracket, but all of their money wasn't taxed at that amount. So you can see that here. I just used a different example. 523,000 plus income earners would be in that 37% marginal tax bracket, the highest one we have. So the effective, that's the flip side, right? That would be the average amount of tax you pay against your overall income. So you would, to calculate that math, you would take your total tax liability after you've done all these brackets, right? So where we stopped in this scenario, you would take your $13,000 divided by your total taxable income, and that would give you your effective tax rate. Now that's going to be slightly lower, right? Why? Because like we've talked about already, not going to repeat that. It's charged at lower rates. Okay, so that's the difference between marginal and effective, and that's very important to understand because those are terms that are thrown out quite often. And definitely, if someone ever tells you, tell your friends, tell everyone, right? If you make 524 grand, you're not getting all of your income charged at 37%. Okay. All right, on to the next slide. So here's one of the other more important caveats that I referred to at the beginning. Tax write-offs. Everyone's probably heard the term, right? Well, that's a write-off. Oh, you can write that out of your taxes. Well, what does that actually mean? So there's two categories that people take tax write-offs in, and that's standard versus itemized deductions. This is very, very important to understand. The government will allow every individual to deduct non-taxable items from their total income. So that's why I made the caveat at the beginning. Let's say you make $100,000. That is not the total you're going to be taxed on because of this standard or itemized deduction route. Now what that means is they're assuming you have write-offs including property taxes, mortgage interest, state taxes, charitable contributions. If you really get fired up, you can go look up the list of all the things that are considered tax write-offs, right? There's probably 50 to 100 of them, maybe more. You would have to talk to your CPA, right? But those are the major ones. So for 2021, essentially, the government has said, we're going to give you a standard deduction. Everyone who files their taxes gets to take either $12,550 off their total income or $25,100 off their total income if they're filing together. So in that scenario, if everyone made $100,000 of income, right off the bat, you're only getting taxed at 87,450. I hope that live math was right. But it's essentially the 100 grand minus your standard deduction. The reason why that happens, right, is that the government assumes in your day-to-day life you are going to come across these write-offs in a scenario where 12,550 is a relevant number. Hopefully that makes sense. So it's really the government is giving you the benefit of the doubt, and they're saying, hey, you know, we know that you probably have write-offs that you come across in your everyday life, so we're just going to give you standard deductions. We trust you. We're going to let you take off $12,550 right off the bat from your taxable income. Now, there's a second scenario where I will say that works for the majority of people. I've always taken the standard deduction, and we're going to talk about why on the next slide. But there's also the option to do itemized deductions, which means instead of taking the standard $12,550, you believe that you can get more of a tax write-off. Let's say you can make that number $20,000, you can reduce your taxable income because you've done more of these things right here, right? Maybe your property taxes are absolutely insane. You paid a boatload of mortgage interest. You make a ton of charity contributions. And that $12,550 is not a representative number of your write-offs, right? So you go this itemized deduction route. Okay, so on the next slide here, we'll talk about what that looks like and why I do the standard deductions. Well, candidly speaking, itemized is just way more work. CPAs would be required to help confirm itemized deductions, right? That they're really deductions. Now, it's pretty clear on the website of what is categorized as a tax write-off. However, keep in mind, you know, Nordstrom, your trip to Nordstrom, $200, it will be very hard to convince the IRS that that was a business expense or a tax write-off, right? That's a quick way to get a audit visit. So going the itemized route is definitely opening you up for a little more scrutiny, right? Because the IRS is going to look at that and say, are those really tax deductions? So hopefully that part makes sense. The other thing is you have to keep all records and invoices, right? If I'm going to reduce a charitable contribution out of my taxable income, let's say it's 10 grand, you're going to have receipts, proof of that payment, proof of the receipt, bank account statements. I don't pretend to know exactly what's required as far as backup goes, but I assume they're going to want you to prove for sure that you made that charitable contribution, right? Okay. And then the second reason, first is it's way more work. Second, for most people, like I talked about, standard deductions will be more than the itemized totals anyway. Especially because, keep in mind, this number has actually increased year over year pretty significantly. I don't happen to know the exact number, but I know that over the past like 5 or 6 years, that standard deductions have gone up, and the government has, you know, for lack of a better term, given people more of a benefit of a doubt and a larger deduction that they can take right off the bat without having to itemize them. Okay, so that's all the slides we had. Hopefully we can keep that fun and exciting. I know taxes aren't everyone's #1 topic, but it is so important to understand because it affects everybody, right? Everyone pays taxes. Come April of next year, you're going to have to figure out whether you're getting money back or whether you owe the government. So hopefully these 5 slides can really help give you an overview of how it functions, and next time you're doing your taxes, a better sense of how those calculations are working. So if you enjoyed the video, please like it down below. Like we said, we're trying to make it to 1,000 subscribers, so everyone helps. We greatly appreciate it. And thanks again for watching. Remember, finance is fun. See ya.